let me get in somebody who actually who actually has advised us now almost every week once for the last 3 or 4, and his advice has proved to be timely and crucial. Independent emerging markets commentator Geoffrey Dennis joins us on the phone line from California. Jeff, before we start off the markets, hope things are all okay out there in California. We heard stories about things being grim out there too.
Well, we are in lockdown, but I think we're getting used to it, and it is what it is. You just can't go out except to go to the urgent shopping and maybe an exercise walk, but you get used to it.
India will now start getting used to it. 21 days of a lockdown, as I'm sure you've heard. Now, Jeff, let's come to what thoughts you have. I remember 3 weeks ago on a Monday, you told us that it's time to play the markets from a recession playbook. I think since then, the markets have come off quite rapidly, both global and local. How do you dissect the moves now that the Fed has come out with this bazooka of a stimulus? Can that alter the trajectory from the recession playbook trajectory that you would have thought we would be otherwise in?
I don't think, I mean, clearly what the Fed does, and presuming there is a fiscal package passed by Washington, which I think there will be, ultimately, it does provide some support for the economy and logically long-term for the markets. I think the issue is having seen the scale of this drop now, which is worth 35% from peak to trough over just 5 weeks, whether these policy moves mean we're somewhere near the bottom. I'm inclined to think that the daily volatility is still going to continue. I'm almost certain the daily volatility is going to continue. But I think you're somewhere near the bottom now. I think you'll probably hit new lows again, but I don't think we're going to go down another 15 to 20% from here because you've come down a long way. Clearly, some of the economic impact of this virus and the lockdowns you're getting around the country are being priced into the market now, and you are getting some significant policy support. But I don't think this is just, back up the truck and buy everything and we're going straight up, because there is too much bad news still to come out yet, which is what's going to give you the volatility.
Markets tend to price in some of the bad news in advance. Jeff, you don't think we are there yet?
I mean, what I said to someone today was that it would be very unusual in a bear market driven by a weak economy, which of course is typically why you get a bear market, for the market to start recovering before you've even had much data giving you some idea as to how bad the economy is going to be. Now, typically what would happen is the market would bottom out as you progressed your way through the recession when there was some optimism the economic data was going to bottom out, or maybe, you were somewhere near the bottom. We haven't even seen any really major macro data yet. The March employment numbers will be interesting. The unemployment claims later this week will be interesting. Of course, the first quarter and the second quarter GDP will be very interesting. So, and if you put it in stock market terms, we don't know what the PE is because we don't know what the E is. We don't know what the earnings impact is going to be, except we know it's going to be very big. And so I think that I repeat what I said. I think you're going to get immense volatility here. I think the amount of downside direction from here will be relatively limited, but I think you've got a lot of volatility still to come. There is one other point I'd like to make if I've got a moment, that is this extraordinary suggestion from President Trump now that he wants to get the economy moving again from Easter onwards. I think played a role in the big rally today, because people said, well, if that's what's going to happen, that's going to cushion the blow for the economy. The problem with that is that twofold. Number one, that goes against the advice of all of his medical team. And secondly, point people should understand overseas is that he doesn't have the call on this. All of these lockdowns are being put in place in the United States by state governments. In California, by the governor of California, Gavin Newsom. So Trump can say what he likes about getting the economy moving again after Easter, but if the governors don't think it's ready, they're ready for that, the lockdowns will continue. So I think if that was one of the reasons why the market rallied today, I think it's probably not a very good basis for that rally, if you like.
Jeff, a follow-up really, since you look at independent markets as well, is the view, I mean, so SGX Nifty, for example, is pointing towards a downtick. I have a two-part question. Howard Marks in his memo said that typically, or I think not Howard Marks, but somebody else who I was talking to yesterday told me, or maybe it was Marks, I don't quite remember, but essentially the point was that the point of maximum pessimism arrives when there are no bounces. Right now, we're seeing a day of selling followed up by a day of sharp bounce, which means there is some optimism left. You reckon this will get over only when that point of optimism completely fades away? Would that be a template to follow?
Well, that's typically the thing people say. You know, you buy when there's blood in the streets, or you buy when everybody's sold, and you have complete capitulation. I mean, I do think this has been a truly dramatic, I mean, the data shows you that, a truly dramatic bear market over a very short period of time. And when you get something like that, you will always get bounces. And this was an extraordinarily strong one today. But I think that I don't think you've had necessarily complete capitulation yet. I think what's interesting about the emerging markets, and I wrote about this and put a report on an article on LinkedIn about it today, is that the emerging markets are actually pretty much down as much or no more than the developed markets this year, which means that unusually EM is not underperforming DM in this big sell-off. I think that's got a lot to do with China. Well, clearly it's got a lot to do with China. China's 36, and the index is only down about 15, 16, 17%, maybe 18% now on the year. And so I think the answer here is that once countries get to the other side of the virus, so you start to see some of these infections begin to slow, like you're getting in China and like you're getting in Korea, you know, economies will recover and markets will recover. With so many countries around the world, we're not there yet, as you know very well, looking at the situation in India. And so I doubt, as I say, to repeat, I doubt we're going down another 15% from here, 20% from the other day, the close. But I think you're going to have bad days with good days. You're going to have a lot more volatility still because we've got a lot of bad news still to absorb.
Got it. Jeff, my final question. What about a market like India? I mean, everybody that I speak to, I mean, and frankly, when I look at the volumes, Jeff, they are very less compared to what you would typically get. I mean, we were down about 17% for the Nifty Bank, and we had only 33,000 crores, which is what, about $4 billion or slightly over $4 billion in the cash volumes. Now, my question is, would you reckon that people are negative right now on India because of the belief that the number of cases cannot be so low and they will go up at some point of time, and therefore go out and short the markets right now? Hedge funds may be doing that, and therefore is the market digesting the oncoming possible bad news in advance? Do you track India that closely now?
I think they're obviously discounting some of this bad news in advance. I think that may be part of the story. Of course, I think the issue with India, I think there's two things here. First of all, apart from all the flow of corporate bad news, of which there's been quite a lot, of course, is the realization that India, the economy, needs help now from the fiscal side. And we've seen a lot of interest rate cuts, so we've seen help from the monetary policy side. But it needs help from the fiscal side, both because the economy is weaker and because of the virus, potential virus spreading through the economy later on. And yet the room the government's got is very limited. So how much do they have in the way of, tools, if you like, policy tools to react to the weakness? If I may say the other thing, and this is not for me to say, I sit in California, it's easy for me to say this, and you're in India, but I was surprised by the lockdown coming so soon in India, because although you have cases of the coronavirus, you don't have many. And I suspect what the government's doing is they're saying, look, we don't want this thing to take hold in India because of the high population density, the number of people who live in difficult conditions in major cities, because if it does take hold, it will be very, very difficult to suppress. And so I think they've had to take these stringent measures, and taking these stringent measures, which will impact the economy further, it's not clear what weapons the government has got to sort of deal with that against the background where, as ever, of course, in India, the valuations are not cheap. So I think this is why India's usual defensive nature within EM is not coming through this time around, at least not at the moment.